You spent 30 years sorting mail, managing routes, showing up every single day, rain or shine. You did everything right. You maxed out your TSP. You stayed in CSRS instead of jumping ship to FERS when everyone said you should. You took the pension. You waited. And now, at 68 years old, you are finally retired. You have got $720,000 sitting in your thrift savings plan, a pension check hitting your account every month like clockwork, and Social Security just went up because Congress finally repealed the windfall elimination provision. Life is good. And then, a letter shows up from Medicare. Not a routine letter, not a welcome to the program letter, a bill with a surcharge you have never seen before. A number you never planned for. And suddenly, what felt like financial security has a hole in it, and nobody warned you it was coming. Here's the thing. This is not a rare story. This is not some edge case that happens to one guy in Ohio. This is happening to tens of thousands of federal retirees right now in real time, and most of them have no idea why. They did nothing wrong. They followed the rules, they saved, and they are still getting hit. So today, I want to walk you through exactly what happened to one retired USPS manager, we'll call him Robert, and why his combination of a pension, a TSP withdrawal, and newly restored Social Security quietly pushed him into a Medicare trap that is going to cost him over $1,000 a year for the rest of his life, unless he does something about it. And I'm going to show you what that something is. But first, let me make sure you understand what we're actually dealing with here, because I think most people, even people who are pretty financially savvy, have never heard of IRMAA, and that is exactly the problem. IRMAA stands for Income-Related Monthly Adjustment Amount. And I know, that sounds like bureaucratic filler, like something a government committee invented to make a simple concept feel complicated. But here is the plain English version. Medicare looks at how much money you made 2 years ago, and if you made too much, they charge you more for your health insurance. Every month, automatically, without asking. Not a little more. We're talking about an extra $69 to over $400 per month on top of your standard Part B premium, depending on how far over the income limit you land. And that's just Part B. Part D, your drug coverage, has its own separate surcharge stacked on top of that. The surcharges are not phased in gradually either. That's the part that gets people. IRMAA works in cliffs. Hard cliffs. There are income thresholds, and if you are $1 over the threshold, $1, you fall off the edge and owe the full surcharge for that entire tier. Not a prorated amount. The whole thing. $1 over the line costs you over $1,100 extra per year. For a single retiree in 2024, that first cliff sits at $103,000 in modified adjusted gross income. And there is a second cliff at $129,000, a third at $161,000, and they keep going. Hello, I'm Anne. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Now let me tell you about Robert. Robert is 68 years old, single. He retired after a full career with the United States Postal Service. He's enrolled in Medicare Parts B and D. He never touched his TSP aggressively during his working years. He let it compound, and by the time he retired, he had built up $720,000 in that account. His CSRS pension pays him $52,000 a year. Solid, reliable. He knew that number cold, and because he wanted to maintain his lifestyle, he started drawing $40,000 per year from his TSP. So at this point, Robert is pulling in $92,000 in income. Pension plus TSP. Now you might look at that and say, okay, he's under the IRMAA threshold. He's fine. And you would be right, if that were the whole picture. But then Congress passed the Social Security Fairness Act, and Robert's WEP reduction, the penalty that had been cutting his Social Security check for years because he also had a government pension, that penalty got repealed. His restored benefit came in somewhere between $18,000 and $22,000 a year. Which is genuinely great news. More money is more money. Nobody is complaining about getting a raise. Except, and here is where people get blindsided, Robert's Magi just jumped from $92,000 to somewhere between $110,000 and $114,000. He crossed the threshold by $7,000 to $11,000. And that means he now owes an IRMAA surcharge every single month for every year his income stays at that level. I want you to sit with that for a second, because this is the thing that nobody talks about when they celebrate the Social Security Fairness Act. Yes, the monthly benefit went up, but for a certain group of federal retirees, the ones with CSRS pensions, the ones with healthy TSP balances, the raise comes with a hidden tax on the other side. Medicare just took a portion of that money back. Look, I am not saying the Fairness Act was bad. It was overdue. But understanding the full picture is what separates the people who actually get to keep their raise from the people who hand a chunk of it back to Medicare every month without even realizing it. Now, here is something I need to explain about CSRS that makes Robert's situation different from a typical retiree. If you have a 401k from a private sector job, a chunk of your contributions went in pre-tax, sure, but there was often some employer match complexity, and there are Roth options that change the tax picture. CSRS is different. CSRS pension income is fully taxable as ordinary income. There is no preferential treatment, no capital gains rate, no special carve-out. Every dollar of that $52,000 pension hits Robert's tax return at his marginal rate. And every dollar of it counts toward MAGI for IRMAA purposes. This matters because MAGI is the number Medicare uses. It is not just your W-2 or your 1099. It is your total income picture. Pension, TSP distributions, Social Security, interest, dividends, capital gains, all of it stacked together and compared against those IRMAA thresholds. And here is something that trips people up constantly. Medicare does not look at this year's income. They look at your income from 2 years ago. So the IRMAA letter Robert got at the start of this year is based on his tax return from 2 years prior, which means if he does not manage his income deliberately right now, he is going to be seeing these surcharges for years, because there is always a 2-year lag baked into the system. That delay is cruel in a specific way. People retire, their income changes, they think they've got a handle on things, and then 2 years later, a surcharge shows up based on income from a year when they were still figuring everything out. Or, in Robert's case, a year when Congress gave them unexpected Social Security income that nobody planned around. So what does Robert do? What do any of these federal retirees do? Let's talk about real strategies, because this is where the video shifts from here's the problem to here's how you actually fix it. The first and most immediate tool is TSP withdrawal timing. Robert is pulling $40,000 a year from his TSP, but the calendar matters more than most people realize. If he monitors his income through the year and realizes in November that he is approaching the IRMAA threshold, he can trim or delay that December withdrawal. Push it to January. Same money, different tax year. If his income is tracking close to the line, say within $5,000, that kind of timing can be the difference between paying the surcharge and not paying it at all. This sounds simple, and honestly, it is, but you have to be watching the number. Most people are not watching the number. They set up automatic TSP distributions, they forget to track where their MAGI is landing, and by December they have already gone over without realizing it. Intentional withdrawal management is one of the most underutilized tools federal retirees have. The second strategy is something a lot of TSP investors have never considered: rolling a portion of the TSP balance into a traditional IRA. Now, I know, the TSP has low fees. It is clean, simple, and most people love it. And I am not saying abandon the TSP entirely, but here is what an IRA gives you that a TSP does not. Access to qualified charitable distributions, or QCDs. A QCD allows anyone who is 70 and a half or older to transfer money directly from their IRA to a qualified charity, up to $105,000 per year in 2024, and that transfer never shows up in their adjusted gross income. It does not appear as income on their tax return, which means it does not count toward IRMAA. Think about that. If Robert is charitably inclined, if he donates to his church, to a veterans organization, to anything that qualifies, he could transfer that giving directly from his IRA, remove it completely from his MAGI calculation, and potentially bring himself back under the IRMAA threshold. He is giving the same money he was going to give anyway. He is just routing it differently, and Medicare does not see it. The TSP does not allow QCDs. That is the limitation. You cannot do a QCD directly from a TSP account. But if you roll a portion of your TSP into a traditional IRA, you unlock that tool. And for a retiree sitting right above an IRMAA cliff, that tool can be worth over $1,000 a year, every year for the rest of their life. The third strategy is Roth conversion, but timed carefully. Here is the thing about Roth conversions that people get wrong. They hear Roth conversion and they think tax efficiency, and they just start converting as aggressively as possible. But if Robert does a large Roth conversion in a year where his MAGI is already elevated from pension income plus Social Security, he could push himself into a higher IRMAA tier 2 years later. The conversion income counts toward MAGI. The move is to convert in lower income years. If Robert can identify a year where his TSP withdrawal was smaller or a year where he delayed part of his Social Security, he should be converting aggressively in that window, filling up his current bracket, staying below the IRMAA cliff, building a growing Roth balance that will never create MAGI exposure again. Roth distributions do not count toward IRMAA. That is the end game. You are paying tax now to remove future IRMAA exposure permanently. I want to spend a second on the psychology of this because I think it matters. Robert did not fail. He did not make bad decisions. He saved diligently. He chose CSRS when it was the better pension. He built a $720,000 TSP balance, which puts him ahead of the vast majority of Americans. But the system is not designed to help you see these interactions coming. Nobody sat down with Robert 2 years before retirement and said, hey, when the Social Security Fairness Act passes and your WEP gets repealed, that extra income is going to push you into an IRMAA tier, and here's exactly how to structure your withdrawals to stay under the cliff. That conversation does not happen automatically, and that is the gap. Here is a number I want you to absorb. According to KFF, the Kaiser Family Foundation, roughly half of Medicare beneficiaries have no idea that their income can affect their premiums. Half. These are people who are already enrolled, already getting the bills, and they still do not know the mechanism behind the surcharges they are paying. That ignorance is not stupidity. It is a failure of the system to communicate clearly and a failure of the financial industry to proactively serve people who are not rich enough to get white-glove advice but too comfortable to seek it out aggressively. And that brings me to something I feel strongly about. If you are a federal retiree or even just approaching retirement with a decent amount saved, please be deliberate about who you get advice from. I am going to say something that might make some people uncomfortable. A lot of financial professionals are salespeople. They are paid on commissions. They make money when they move you into certain products. That is not inherently evil, but it is a conflict of interest, and you need to know it exists. If someone sits down with you and the first thing they want to talk about is an annuity or a whole life insurance product, ask yourself, who benefits from this recommendation? You or them? A fiduciary is legally different. The SEC requires fiduciaries to put your interests first, not second, not alongside their compensation. First, they cannot recommend something because it pays them a better commission. That legal standard changes everything about the advice you receive. If you do not have a fiduciary advisor and you have a situation even remotely like Robert's, a pension, a TSP, Social Security, Medicare, I want you to go to advisor.com and use their free matching tool. It takes under 3 minutes. They match you with vetted fiduciary advisors from firms like Vanguard, Empower, and Edelman. People who are legally required to work in your interest. People who will actually model your MAGI, identify your IRMAA exposure, and help you time your withdrawals around the cliffs. The tool is free, the conversation is free, and the cost of not having it, in Robert's case, is over $1,100 per year, every year, for the rest of his life. Go to advisor.com, see who you match with, and get the answers you actually need. Now let me bring this back to the big picture because I think there is something more important than the technical mechanics here. The Social Security Fairness Act was a real win for millions of federal workers who had been penalized for their public service careers. That is true. And the WEP repeal is giving people money they legitimately earned and were being unfairly docked. Also true. But in personal finance, every piece of good news comes with a secondary question. What does this change? What else moves when this moves? Robert got a raise. The raise also lifted his MAGI. His MAGI crossed a cliff. The cliff costs him over $1,100 a year. If he does not know that, if nobody modeled it for him, he is essentially giving part of his raise back to Medicare without understanding why. That is the mistake. Not saving, not retiring, not taking Social Security. The mistake is assuming that good news has no downstream consequences. Because in a tax and benefits system this interconnected, almost everything has downstream consequences. So here is what I want you to take away from Robert's story. If you are a federal retiree or close to retirement with a CSRS or FERS pension, the first thing you need to do is calculate your MAGI. Not guess, not estimate, actually calculate it. Add up every income stream: pension, TSP distributions, Social Security, interest, dividends, anything, and compare that number to the current IRMAA thresholds. Know exactly where you stand. If you are within $10,000 of a cliff, you need a plan. Whether that's trimming your December TSP withdrawal, considering a TSP to IRA rollover to unlock QCD eligibility, timing a Roth conversion into a lower income year, or doing all three in a coordinated strategy, you need a plan, not a rough idea. A plan with numbers. If you are comfortably under the threshold right now, do not get complacent. IRMAA thresholds are adjusted for inflation each year, but income tends to grow faster than adjustments, especially if you have required minimum distributions starting at 73 or if market performance pushes up the value of your TSP. Your MAGI situation in 3 years may look nothing like your situation today. And if you have been assuming that someone, your HR department, your union, your financial advisor, Social Security Administration, was going to proactively flag this for you, I want you to let go of that assumption right now. Nobody has that job. Nobody is sitting in a back office watching your income and sending you alerts when you're approaching an IRMAA threshold. You are the one who has to watch it. Or you need to hire someone whose actual legal obligation is to watch it for you. That is the fiduciary relationship. That is the value of it. Not just investment management, not just picking funds. It is someone who looks at your complete financial picture, pension, TSP, Social Security, Medicare, taxes, and helps you see the interactions before they cost you money. Look, I am going to be blunt with you because I think that is more respectful than dancing around it. A lot of people watch videos like this one, feel informed, feel like they understand the problem, and then go back to doing exactly what they were doing before. And I get it. It is overwhelming. There is a lot of moving parts. It is easier to assume things will work out. But Robert's story is not hypothetical. Versions of it are playing out right now, every January, when IRMAA letters land in the mailboxes of people who saved responsibly, who retired with dignity, who followed the rules, and who are still getting surprised by a system they didn't fully understand. You do not have to be one of those people. You have the information now. The question is whether you act on it. Go calculate your MAGI today. Look up the current IRMAA thresholds on Medicare.gov. They update annually. See where you land. And if you want help from someone who is legally required to put your interests first, go to advisor.com and take 3 minutes to find your match. Robert's situation is fixable. The surcharge he's paying right now does not have to follow him for the rest of his retirement. With the right strategy and the right advisor, he can restructure his withdrawals, unlock tools he wasn't using, and potentially bring his MAGI back under the line, keeping more of the raise Congress gave him. Your situation is fixable too, but only if you stop assuming everything will work out and start making it work out. That's the move. Make it.